Well, good morning, everybody. So it's nice to see all of you. I can't see all of you, but it's nice to know you're there. And let me just summarize. What I'm going to try to do at the beginning of classes is summarize the things from the previous class that are the most important building blocks of this course. Last week, I introduced to you the paradox that we have seen some big change going on in the late 70s, early 1980s. And between 1946, the Second World War, and the late 70s, early 1980s, the median wage, that is the wage of the typical worker adjusted for inflation, kept on going up exactly in tandem with productivity gains. And that's what we would expect. As the economy grows, everybody would share in that growth. But then in the late 70s, early 1980s, something quite dramatic happened, a big change. Wages began to level out. They didn't continue to grow up, even though the economy kept on growing. Productivity kept on increasing, and obviously the number of people working kept on increasing. So the whole national economy kept growing, but wages began to stagnate for the typical person. Now, as I also said last week, we are focused on the United States economy because the United States economy gives us a lot of data, historically and every other way, but also we know that almost every other economy in the world, particularly advanced economies, are following the same trend line. They are behind the United States in terms of inequality, but they're becoming also less equal in terms of income and wealth. And to the extent that they are keeping data on racial inequality, also racial inequality, and other types of inequality we will get to. We then last week looked at poverty. We simply measure it in a very static way in the United States. We assume that poverty is the same way of measuring as we did in 1962, 4 times the typical breadbasket that the family needs minimally, but that doesn't take into account the cost of housing, which has dramatically increased, nor does it take account of other expenditures that have increased much faster than inflation, like education, higher education, to take another example. We also last week looked at the difference between wealth and income. And I explained to you that income is a flow over time, whether it's hourly or weekly or monthly, but wealth is the kind of reservoir into which that flow goes, if you have any savings at all. And if you accumulate savings, and you might put those savings into the stock market or into a house or into any other place, but that is wealth. And inequalities of wealth in the United States are much larger, particularly by race, than inequalities of income, because those inequalities of wealth reflect historical accumulations or failures to accumulate a lot of money. Finally, last week, we turned to the question of should we care? I mean, inequality is widening dramatically in the United States, has been widening dramatically since that U-turn or that paradoxical point in the late 1970s, early 1980s. We still have to examine what happened. But do we care? Should we care? I asked you a number of questions about that. And many of you were uncomfortable with the genie example, where I said, well, look at everybody gets, if I snap my fingers, do you like everybody getting better off? Of course, people at the bottom will get off, will get better off, just a slightly better than people at the top. In fact, people at the top will do much better than people at the bottom. Inequality will widen, but everybody will do better. Many of you were uncomfortable with that. And then we tried to do a kind of what I call the $1,000 experiment. And some of you either the recipients of my putative $1,000 or the recipients of the person getting the $1,000, how much of the $1,000 would be shared. Many of you were talking about issues of fairness or power, or there were a lot of other pieces of language that I want to unpack over the next few weeks. What's wrong with widening inequality? Well, we will examine that as well. Today, I want to begin with you the process of peeling back the onion on the fundamental question of why inequality is widening so dramatically and why the late 70s, early 1980s. What happened? We can't even begin to discuss public policies to ameliorate or reduce widening inequality until we know what happened and why it happened. And that's why history is so important. We're going to start today with capital markets, with the investor's view, because that's one important portal. That's one important way of looking into a very complicated system that we need to understand as that system has evolved. The investor's view. Today, I'm going to be looking with you at your own personal values. Maybe your personal values will give a clue as to what's happened. And then we're going to look at pay at the very top. Why has pay dramatically increased at the top? What has happened to pay at the top? We'll be looking at the capital market, and then we'll take a little break, and then I want to do a simulation with you. And hopefully we can do it today. I may be asking you some questions like I did last week. The Acme Widget Corporation will look at profits and wages overall, profits and wages, and we'll also look at the purpose of the corporation. Fundamental issues, fundamental building blocks in terms of your understanding of what has happened and why. Starting with personal values, and maybe this is one way. I made a decision. This is one way in, and I'd like your views. So how important, just in terms of your own personal views, is it to you to preserve neighborhoods with small shops and bookstores? Is it quite important or not really important? Go. Well, 88% of you say, A, it's very important to preserve neighborhoods with small shops and big bookstores. 11% of you say B. Well, that's pretty overwhelming in terms of your views. I want to get to one more value issue, and then I'll explain why. Steady jobs and good wages. How important is it to you to maintain steady jobs and good wages for American retail workers, manufacturing workers, airline workers? Is it quite important, or is it not really important? Go. Even more important, even more overwhelming, 94% of you say it is quite important. And we've got 5% of you, 31 of you saying not really important. Okay, well, now I want you to keep those in mind. Overwhelmingly, you love small shops and bookstores, and it's very important to you to have good jobs and good manufacturing jobs. But I got to ask you this question, and forgive me for asking it, but do you shop online for a lot of things? Yes or no? Go. Aha. Well, almost 80% of you do shop online for a lot of things. 20% of you don't. The reason I ask this kind of inconvenient question is, do you see a slight contradiction there? Do you seek the lowest price goods and services such as, well, for example, clothing and flights? Yes, of course, or B, no? Go. Again, pretty overwhelming. Yes, you do. Well, here's what I want to emphasize. there is a little bit of a cognitive dissonance, a little bit of an inconsistency between, on the one hand, your values as citizens, in terms of you love small shops on Main Street and you love bookstores, and you want people to have very good wages in manufacturing and airline flight attendants and everybody else. But on the other hand, you're buying a lot of stuff online, which doesn't really help Main Street. In fact, it undercuts Main Street. And you're also seeking the lowest price goods and services, presumably from all over the world, which is undercutting, presumably, or at least is slightly inconsistent with high wages and good working conditions for a lot of manufacturing and airline workers and other people. In other words, what I want to bring to your attention, just starting off this question of why are we seeing inequality widening, I want to suggest to you that, and I hate to begin with this, it's sort of uncomfortable, but you see, you might be implicated in some way. In fact, I think that it's fair to say you do have a little bit of a split brain around these issues. That is, you have a consumer brain and you have a citizen brain. Your citizen brain says you want main streets, you want small shops, you want bookstores, you want people to have good wages, you want people who are manufacturing workers to do well, but that's your citizen brain. The consumer brain in you really wants the best deal you can possibly get online if necessary, and you're going to shop and make sure you get the lowest cost. And a lot of the goods you buy and the service, even the services you get, are going to be coming from around the world where people are not doing nearly as well as American workers. You might actually be inadvertently undermining the competitive position of a lot of American workers. The point I want to make to you is that we are all consumers and workers, but we're also citizens. And we, in terms of how we make this trade-off, may not even be aware that there's some tension between our roles. So why does the consumer in you so often win over the citizen in you? Is it because, well, you'd like to be a better citizen, but you have very limited resources? Or is it because you just simply don't connect your pursuit of good deals to the consequences of your pursuit of the good deals that you might dislike? Or you're just not prepared to sacrifice those good deals for the sake of better social consequences because you don't believe anybody else is going to be. You don't want to be sort of the only person out there who is deciding not to use the internet and not to get the best possible deal you can, because why do that? You'll be sort of, well, nobody else is doing it. What do you think's the major reason here? Go. Well, most of you, 54% of you, say it's because you have limited resources, and that's certainly true. You're not prepared to sacrifice, but there are a lot of you who are quite honest about it. 20%, you don't connect the two. And there are a number of you who are aware of a kind of what we might call a collective goods problem. That is, you're not prepared to sacrifice a good deal if you don't think, for the sake of some social outcome, if you don't think anybody else is sacrificing either. I want to suggest to you the social science data actually shows that all three are operative here. A little bit of a trick question. It's limited resources. The median wage has not increased, as I said, for 40 years, stagnant wages for many people. Many people have been on a downward escalator, but a lot of people don't connect what they're doing and the pursuit of the best deal to the social consequences. But many people are not prepared to sacrifice if they don't think other people are sacrificed, which, let me just put a little flag down on that one, because the way we overcome the kind of collective goods problem in which I'm not going to sacrifice because I don't know whether anybody else is through laws and regulations that require all of us to make similar kinds of sacrifices, whatever the issue is. I'm not, and please don't get me wrong, I'm not calling for laws and regulations that prohibit anybody from online retail sales or prohibit anybody from getting the best possible deal they can. I'm just suggesting a more general point. And that is that if we want to overcome the collective goods problem, the way we overcome that, and that problem again is I'm not going to sacrifice if nobody else is sacrificing. The way we overcome that is through laws and regulations that require everybody to do something. Which gets us to pay at the top. Why has it risen so much? I mean, take a look at this. We're going to now look at a chart of CEO to worker compensation ratios. That is, you have numerator, CEO pay, denominator, the pay of the typical worker, and look what has happened. In 1965 and 1970, actually, I started to look at this in detail in the late 70s. It was about 31 to 1. And then it went to 61 to 1, CEO pay. We're talking about, by the way, big companies, not the CEO of a little small business. This is CEOs of big companies. And now in 2020, it's 351 to 1. Oh, what's going on here? Why have we seen this? Well, let's explore this a little bit. Is it, first of all, let me ask you, I want your judgment, your hunch. Is it because there are only a limited number of star performers, star CEOs, so they can command higher pay? Or is it B, they've generated larger returns for shareholders, so they deserve higher pay? Or is it C, they've gamed the system, so they get higher pay? What do you think? Go. Oh, you are so cynical. 72% of you think CEOs have gamed the system. Only 16% of you think that they're star performers. And 11% of you think that they've done so well by shareholders. Well, I'm going to have to play devil's advocate, as I thought I would, and try to disabuse you of your prior assumptions a little bit here. Let's look at pro athletes. Now, when I first got interested in baseball, a fellow named Mickey Mantle, he was way before your time. I mean, he might have been before your parents or even your grandparents, but remember his name and ask them about Mickey Mantle. He was a star on the Yankees when the Yankees were still with New York. Well, Mickey Mantle was earning very much less than Carlos Beltran in 2005 and Alex Rodriguez in 2013 and Mike Trout, Los Angeles. Look what 37 million? Now remember, we're talking about the same 2020 dollars. So don't worry about inflation. In other words, Mickey Mantle in 2020 dollars, if he were paid today, would be making $845,309. But look at Mickey Mantle is just getting nothing compared to Carlos Beltran or Alex Rodriguez or Mike Trout. Well, wait a minute. Maybe there's something about being a star. Maybe, well, let's take a look at star performers, entertainers. And we can compare Clark Gable, again, way before your time. Clark Gable was a movie star in time of maybe your grandparents, right? He was a romantic lead. He was fabulous. You just look at some of his movies, and then let's compare. Again, we're looking at the same dollars. Robert Downey in terms of Iron Man 3, just one movie, and then Dwayne Johnson. So let's take a look at what's happened to movie stars. Whoa! Okay, so Clark Gable, in today's dollars, remember we've adjusted for inflation. In today's dollars, Clark Gable would have earned this year $5,600,000 last year. Robert Downey would have earned 83 million and Dwayne Johnson 85 million. What's going on here? Why are star athletes and movie stars doing so much better than they did before? Does that tell us something about CEOs? Hello? Well, let's look closer to home. Let's look at Berkeley's annual gross pay. The latest data we have is from 2019, and we're going to be looking at everybody from the head football coach to the highest paid professor to the chancellor and the dean of Haas, business school, and then the dean of Berkeley Law, and the full professor, an assistant professor, lecturer, GSI, custodian. Let's look at their gross pay. By gross pay, I mean before taxes. And let's see if we can, well, the custodian is $43,472 in 2019. GSI, well, the GSIs are now unionized, but honestly, they are worth every penny. They're worth more than that. I think the custodians, my values, are worth more than that. Lecturers who do a lot of the work in Berkeley in terms of classroom work, look at $57,456. Okay, an assistant professor, $86,600. How about a full professor? A full professor at Berkeley, $175,800. The dean of Berkeley Law School, $451,181. That's pretty damn good, if you ask me. Dean of Haas, well, it's interesting. Haas Business School gets more than the dean of the law school. Wonder what's going on there. Okay, let's look at the chancellor. Chancellor's doing even better. Highest paid professor, $609,400. Better even than the chancellor. Okay, head football coach, $3,113,334. What in the world is going on here? What do you think is going on here? Could it be that star CEOs are like the head football coach? There are not many of them. They are worth a huge amount of money because there are not many who really do it very well. Maybe, but hold that question, because I want to explore something else, and that is the role of the capital market. Now, don't get nervous. Some of you, when I throw around words like capital, your eyes glaze over or you get a little bit anxious. No, I just simply want to talk to you candidly about how wealth is aggregated and distributed. So corporate profit margins, 2020, and we're looking at big companies, and we're going to look at how wow, look at that. Corporations are doing remarkably well. Now, remember, this is pandemic time, and starting in 2020 and right through the second quarter of 2021, corporate profits margins, and this is adjusted for inflation, folks, this is really high. In fact, big corporations have not made this much money in 70 years. So maybe CEOs are getting paid a lot because they've done a lot. They're making a lot of money for shareholders. Let's look at stock market returns since 1978. Again, we're looking at big companies. Well, look at this. I mean, the stock market for years didn't do all that well. In fact, in 1929, there was a little bit of a dip. Can't even see it here because relative to what's happened since then. Oh, and look at this. This is the big growth that occurred, started to occur in the early 90s. Well, what do we know about the early 90s? What we know is the stock market has started to really do well, and we also know that I was labor secretary. And so obviously that's what happened. Hello, I'm no, it's not. I'm just kidding with you. Uh, and then it went down. There was a correction in the early 2000s, and then we had obviously the explosion, the bubble burst on Wall Street in 2008. But look what's happened. It's just since then extraordinary. Now, last week was not a good week, and if we put everything onto here, we would find that we are actually, this would be kind of a little bit of a dip here, but basically, this is a extraordinary performance. So maybe CEOs are getting paid because they've done so well for shareholders. Look at the Dow Jones Industrial Average closing prices. Another way of looking at what we just looked at. Again, investors have never had it so good, except for last week. CEO compensation, that's the amount that they're paid, tracks the stock market exactly. And so let's look at, this is the S&P 500 index in terms of what the biggest companies, how they have done in America. And here is CEO compensation. Pretty close. Well, that suggests, doesn't it, that CEOs are getting paid for their performance. I mean, their job is to maximize shareholder returns. And that's exactly what they've done. Here's the thing. If you look at the composition of CEO pay, I mean, I'm a CEO, let's assume, how much of my pay is in direct payments and how much of it is in shares of stock or stock options, whether I can buy or I can sell stock. Let's take a look. More and more of it. This is starting in 1992, 1993. There's a kind of takeoff point. More and more of CEO pay is based on the stock market because more and more of CEO pay is in shares of stock and stock options. That is an option to buy a share of stock. But for the purpose of this chart, we're talking about them both together. Well, I'm a CEO. I'm getting paid a lot in shares of stock, and obviously that means my goals are aligned with the goals of shareholders. They are doing well because I'm doing well. I'm doing well because they're doing well. It's a perfect kind of alignment. Well, this sort of raises another question, doesn't it? Why so much CEO pay in shares of stock? What explains the dramatic shift to performance-based pay since the early 1990s? Here's where I've got to explain something to you because I was there. You know, sometimes we look at a market, we look at history, we look at politics, we look at what's happened to incomes, we look at CEO pay, and we say, well, it just evolved. I mean, it's just norms changed, it's just values changed. No. Often, there are very specific policy decisions Sometimes these policy decisions are made in specific points of time, in specific rooms. Sometimes they're made around tables, and the people, only a handful of people are there. Under Bill Clinton, Bob Rubin, who was head of the National Economic Council under Bill Clinton, and the three of us were charged by Bill Clinton with deciding what to do about CEO pay. Now, during the campaign of 1992, Bill Clinton had made a big thing. CEO pay is getting out of control. And he got a lot of positive feedback for that. His political consultant said to him, emphasize this. This is a very important point. People like to know that CEOs are not basically getting that much more pay than everybody else. So whatever ideas you have, go for it. And Bill Clinton said, as a policy idea, to be truthful, I had whispered it in his ear as a candidate. Companies should not be able to deduct any CEO pay or any executive pay over $1 million from their taxable corporate incomes. Well, that was a good campaign idea. People like that. And then Bill Clinton, once he was president, he asked the Secretary of the Treasury, Lloyd Bentsen, and the Secretary of Labor, me, and Bob Rubin, chairman of the National Economic Council, to figure out how this was going to be operationalized. Here is what happened. I, in my own naive way, said, well, Bill Clinton promised that no CEO pay over $1 million is any longer going to be deductible from corporate income taxes. Okay, that's it. But that's not what Lloyd Bentsen or Bob Rubin wanted. Lloyd Bentsen and Bob Rubin said, well, wait a minute. Shouldn't corporations be allowed to deduct from their corporate income taxes executive pay in excess of $1 million if that pay is connected to company performance? Maybe that should be the rule. And I said, no. Clinton was very clear on the campaign trail. No, you can't deduct any executive pay from your income that is going to be taxable income, your corporate taxable income, anything over $1 million. Rubin and Bentsen outvoted me 2-1. They said, from now on, we're going to have a Treasury regulation that says companies can deduct executive compensation in excess of $1 million if that compensation is related to performance. And what did performance mean? The stock market. That's where it began. I was there. I hope you never have the experience I have had repeatedly of being in conference rooms or making arguments behind closed doors that I think are right and they prove to be correct, and it doesn't matter because things happened, like the explosion of executive compensation. Part of what we have seen with stock buybacks. Now, let me just explain what stock buyback is. If a company has a lot of money, a lot of income, as companies do now, one way of raising the prices of their shares of stock is for them to use their cash, and they, as a corporation, buy back the shares of stock, leaving fewer shares of stock outstanding. And just in terms of supply and demand, if there are fewer shares of stock outstanding, then each outstanding share of stock is going to be worth more. And that's why buybacks became and have been a very popular way of increasing the value of shares of stock for companies that have a lot of cash. And what we can see is, again, over the last years since 2009, share buybacks continue to increase, but that means companies have less of their cash to invest in new machinery, research, innovation, pay for their line workers, their typical workers, hourly workers. They're not reinvesting it. They are putting more and more into buying back their stocks. Why are they doing that? Because they want to have higher stock prices. Why do they want to have higher stock prices? Because more and more executive compensation is coming out of shares of stock. Why is more and more executive compensation coming out of shares of stock? Because I could not convince the other two of my comrades in the Clinton administration to have a different rule. Which gets us back to an issue we talked a little bit about, or I introduced to you last week. What percent of US stocks are held by the richest 1% of Americans? What do you think? Is it 10% or 20% or 30% or 40% or 50%? What do you think in terms of the actual value of stocks, not the number of stocks, but the value of stocks held by the richest 1%? What do you think? Go. Some of you, about almost 30%, think it's 40%, and a majority of you think it is 50%. Well, let's take a look and let's find out. This is a chart produced by Goldman Sachs on the basis of the latest data available. And what we can see is it used to be the top 1% owned 39% of the value of all shares of stock, and the top 1/10 of 1% in terms by wealth owned much, much less, about 13%. But by 2016, and it's higher today, the latest data actually I've seen, but I'm going to trust this graph because it's better data, is the top 1% owns 50% of all shares of stock. The wealthiest are getting a big, big ride and have been getting a huge ride on the rise in the value of the stock market. Which gets us to something we talked a little bit about last week, but I want to get in deeper because now is a good time to look at the net worth of, when I say net worth, I'm simply talking about how much wealth they have of people 70 and older as a share of the total GDP, and then look at wealth transfer. Now, what you can see is that people who are 70 and older have more and more and more and more of the GDP, the entire national economy. A lot of this is in shares of stock. A lot of this is because, as we've seen, the shares of stock and the value of the shares of stock have increased dramatically. This goes up to 2021. Pretty good data. And let's look at what they are given. This is gifts to heirs right here, donations to charity right there, bequests to charity, which are like donations, but they have to do with sort of when people die. And these are bequests to heirs. This is the generational transfer. These over here are wealthy boomers who have ridden the stock market, particularly this huge increase in the value of the stock market. And this is what is anticipated, and this is between the years 2038 and 2042. This is what's anticipated in terms of, on the basis of trends, how much of that goes to their heirs, their children and their grandchildren. So, in other words, what we've been examining today, the wealth at the top, not just executives, not just CEOs, but actually it turns out we're looking at all the wealth at the top. A lot of it's related to the capital market, what's happened to the capital market, what's happened to the stock market, and we can see it has enormous implications, not only for today, but for the future. So I want to do a little bit of a simulation right now that may further elucidate some of the issues we have been talking about. Now, up until now, it's still a little bit of a mystery. Why did executive compensation soar? Most of you started out this hour or last hour. Most of you said CEOs are manipulating the system, and then I kind of pushed back and said, "Well, look at the stars of performance-based stars in terms of entertainment and athletes. And then look at what has happened to the stock market and look at what CEOs have managed to do. And it's performance based there too, isn't it? Well, let's just try this. Let's assume that I am the CEO of the Acme Widget Corporation. We make widgets. We make Acme widgets. And people call me Hacksaw Bob. I don't know why. I think it's because well, maybe I'll show you. So I'm going to, and I'm Bob Dunlop. And I want to give you both the current trend in terms of Acme's profits, and I want to give you my plans. And I want you all to be in this simulation members of my board of directors, all right? Okay. So here we are. Here's the current trend. I'm sorry, this is the current trend. This is year 1, year 2, year 3, year 4, year 5. We're not doing terribly badly, but it's not really fabulously. We're on the way to making $50 million. But look, I have some ideas here how we can make much more money. And I want to present to you my plan A. And I'd like you to consider it because you are the board of directors and your responsibility is to maximize shareholder returns, right? Of course. That's what you're there for. You are representing shareholders. That's what a board of directors is supposed to do. Okay? So here's my big way of saving money. The more money we save, the more money we're going to have in profits, and those profits are going to translate into higher share prices because share prices reflect the present discounted value of the expectations of future profits. Okay? Are we all together? By the way, I'm just playing a role now. I'm going to be pretty insistent, but I want you to know it's not really me. It's just my role. Okay, here's my plan. We cut payroll costs by 60%. We reduce wages of all employees except top executives by 40%. We eliminate health care and retirement benefits for all employees except top executives. And we accomplish this by firing 25% of the workforce, and we outsource jobs abroad, and we substitute software where we can't outsource abroad, and we improve overall efficiency. And then we're also going to move our plant to a non-union state where it's very difficult to organize. Okay? You all with me? Everybody happy? I want you are my board of directors. I want you to go. By the way, this plan comes from, it's not just coming from me. I hired management consultants. They were the best in the country. They came up with this plan. They've told me there are all kinds of ways. We have too much fat in this company. So we can reduce the fat and look at how much money. I mean, we can actually cut payroll costs by 60%, and we can therefore have more profits and higher share prices. Of course you want that, right? How many of you are in favor of plan A? A, yes. B, no. I want yes. Go. Now, I don't have to remind you that you have a fiduciary duty to maximize shareholder returns. You're representing the shareholders, so I want you to approve this plan. I want a majority of you. If you know what you're doing, you will. Okay, let's see what you say. I don't understand. 70% of you don't want this? Well, that makes no sense at all. I'm I'm appalled. Is there any way you can anybody who doesn't like this plan, can you tell me why you don't like it? Can you put up your hand?
Yeah, hi, Professor. I feel like, well, yes, it is a responsibility as a shareholder on the board to increase profits. Just me as a human being wouldn't be able to sleep at all knowing that, first of all, reducing wages for all employees is completely unacceptable. They all deserve at least a living wage, and then healthcare and retirement benefits should be just basic human rights, in my opinion. So, while yes, making money is important as a board member, as a human, I can't really come behind this plan.
Remember, I'm playing a role. Well, what are you talking about? That makes no sense at all. You chose to be on this board, right? You didn't have to be on this board. You chose to be on this board, and by choosing to be on the board, you took the responsibilities that go with being a board member, and you have a fiduciary responsibility. And by the way, I haven't even mentioned something else, and that is if we don't maximize shareholder returns, you know what's going to happen? We're going to be taken over by a private equity firm that knows that there's a lot of fat that can be trimmed, and they are going to do exactly what I'm suggesting we do. And why don't we do it before they do it? Because when they do it, we're going to all lose our jobs. Okay? Does that answer your question?
Well, I think we might lose our jobs anyway if we do this, because if we don't have a workforce that feels like they're valued and that their lives are just as important as ours, they're all just going to quit. So I feel like,
I mean, with all due respect, that's just liberal, progressive, uh, you know, uh, just seat of the pants bullcrap. I mean, that makes no sense at all. This plan was put together by the best management consultants in this country. They know what they're doing. They've done this all over the country. And the hourly workers, I don't, hourly workers are hourly workers. If hourly workers are not going to work, if they're not going to put in a full day's work, if they're not going to be reliable, we fire them. Hello? Anybody else? You're with me, right?
Yes.
Yes, you are.
No, oh, no. I am not with you. I do not think that we should have this plan.
Why are you going to give me the same sort of bleeding heart stuff I just heard? Or you?
I mean, so regardless of whether it's a moral thing to do or not, we're going to lose a lot of morale in the workforce. It costs a lot to rehire people. If we create a bad reputation, we're not going to be able to get any more employees to do the work. And this also shows extreme favoritism to the top executives, which is not going to work for us because we need the low-level employees to do all of the work for us.
Well, of course, we need them to do the work, and if they don't do the work, we fire them. And by the way, what's the problem with substituting artificial intelligence, and outsourcing abroad? Every one of our competitors is doing exactly the same thing. What I don't understand. I mean, I understand. You went to Berkeley and blah 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 blah, but you just have to have a hard head about this stuff, don't you? I mean, again, we have a fiduciary responsibility to our shareholders, and we're going to be taken over by private equity, by the corporate raiders, the modern corporate raiders, if we don't do this. And you think it's going to create a morale problem, but I'm saying to you, there's no morale problem. Because it's. Are you worried about the morale of artificial intelligence? And if there's a morale problem, and people are not functioning, we just fire them. There are a lot of other people that want these jobs.
But is artificial intelligence software really at the level we need it to, or can it be too unpredictable? And if we lose all of our bottom workforce, then we have no one to even train these programs to do what we need them to do.
No, we're not going to lose them. I mean, the people want jobs. People need jobs. We're not going to lose anybody. The people we lose probably, I'm going to put on my economics hat right now. They can move to higher and better uses. I mean, why keep people in places and doing things where they're not efficient? I mean, why not be efficient? Why the whole economy needs efficiency? Let's move people to their highest and best uses, and not keep them collywog them, kind of pretend that they are doing important work or useful work when we don't need them. That's the highest insult. You know, you want to respect workers. Make sure that you have workers who are actually needed. We don't need them. You get it?
Okay.
I want remember, this is not me. I'm playing a role. Anybody else? I want you to. I really want you to vote with me, because if you just understand our fiduciary responsibility, we're going to be taking over modern economics, just efficiency, and you want to put people in the highest and best uses, and you don't want a lot of companies that have a lot of extra people working, and it's just fat. It's just fat. Cut the fat. Are you with me now? How many of you are with me? How many of you have come around to understand we got to go with this plan A? And again, A, yes. B, no. I want to hear it. I want to see you with me. A, yes. B, no. Go. I don't think I had any effect at all. I'm going to go back to my real self. Now, I'm no longer. The purpose of this exercise is to not just caricature CEOs. It is a caricature of a CEO, and CEOs don't act like that. These are actually arguments that are often made, and maybe these are more extreme, but these are the kind of arguments that have been made in executive suites for much of the last 30 or 40 years in terms of slimming down and being more efficient and avoiding takeovers, and also being fiduciarily responsible to shareholders. What we need to recognize is that even though your sympathies lie with not reducing the number of jobs or not cutting wages, these are the incentives that are operating on many companies right now. I have even bigger savings. Bigger savings. You want to know how to get bigger savings? Well, I can cut the costs of worker safety. You know, we're paying a fortune for these little lockdown gadgets that are ever on every machine. When the machines are cleaned and when they're shut down for cleaning, you have these little lockdown gadgets, and they cost a fortune, and we're not going to do them anymore. And we're going to eliminate overtime pay. I just don't want to give overtime pay. No more overtime. Yes, people are going to work overtime. We're just not going to give overtime pay. And we're going to fire everyone over 45, so hourly employees are at a lower pay scale. Hello? Why not do that? And not promote or train women. I mean, women, they're just going to leave and have babies. So we're not going to promote or train women. And then we're hiring undocumented immigrants because they will not complain. I'm just doing a caricature. And I won't even ask you whether you like all this. The reason, and now I'm back to my real self, the reason I put all of these Plan B in there is because it is rare but not all that unusual. Rare, but actually, unfortunately, it happens fairly often that companies will break the law if the cost of breaking the law is less than the benefits in terms of profits. When I was Secretary of Labor, for example, there was a large tire company, Bridgestone Firestone, working out of the Midwest. And they refused to use the little lockdown machinery that I just referred to. And as a result, workers were losing their fingers, and a number of workers lost their limbs when the machinery started up again, accidentally, when the workers were cleaning the machinery. And as Secretary of Labor, I had only a certain amount of penalty under the law. I could levy fines on those companies, on Bridgestone Firestone, only up to a certain level. But beyond that, I couldn't. And Bridgestone Firestone, a big tire company, at that time it was based in Japan, uh, kept on basically flouting the safety laws of the United States, of OSHA and back with OSHA, the United States. So it's not all that. I wish I could say it's very rare, but occasionally companies do, where the cost, again, the cost of being fined is less than the benefit of getting away with some of these illegalities. And that benefit and cost, you've got to figure in also the risk of being found out. A lot of companies, sad to say, some companies, not a lot, some companies do take the risk that they are not going to be discovered. Which gets us really to what has happened to profits and wages overall. And the headline here is that corporate profits have been increasing faster than the overall economy. This takes us up to about the present day. And what we see is that here's the nominal economy, the nominal gross domestic product, not adjusted for inflation. Here are profits, not adjusted for inflation. So we're just looking at profits versus the nominal GDP. And what we see here is that profits continue to grow faster than the overall economy, corporate profits. Now, why are corporate profits growing faster than the overall economy? Because companies presumably are doing everything they can to maximize profits. What are they doing? Well, one thing they're doing is keeping wages as low as possible. Another thing they're doing is limiting the growth of their workforce. They are outsourcing abroad. They are bringing in machinery, artificial intelligence, software to replace workers. They are moving or threatening to move to anti-union states or states where it's very difficult to form unions. In other words, they're doing all of the things that Hacksaw Bob, in the caricature way I presented him, was doing. They're also buying back their shares of stock with these corporate profits. But the most important thing is for you to know that corporate profits have been increasing faster than the overall economy. And it's happening not by accident. It's happening partly because of innovation. I don't want to suggest that companies, the products and services are not getting better. They are to some extent. But the big news is that companies have been doing everything they can to reduce the costs of production. And the biggest cost of production, 70% of the cost of production, is workers, wages. So what we see is that as a percentage of the total economy, and here we're just going to look at, and here's starting in 1985, and we're going to go all the way up to 2019, the latest data for which we have good data, the latest date for which we have good data. We're looking at corporate profits as a percentage of the total economy. And you can see the trend line here is from a relatively low percentage to still low overall, but much higher than it had been because of all of the techniques that I suggested to you. On the other hand, if we look at wage and salary income as a share of the economy, again, starting about the same time and ending about 2019, and we're looking at wages and salary as a percentage of gross domestic product, what we see is a trend in the opposite direction. And because I'm sort of loading the dice here because I'm including salaries, not just hourly wages. The lower wage workers are paid on an hourly basis. Now I'm even including salaried workers. who are getting paid. The point is that the pay as a share of the economy keeps on declining. So what we have, generally speaking, in our society, one of the drivers of inequality is that you've got more and more of the resources of the economy ending up in corporate profits, which are showing up in high share prices, which are owned by people at the top, or certainly the top 10%. And you've got salaries and particularly wages stagnating or barely growing at all in terms of a share of the overall economy. If you look at wages and salary in terms of 50 years, the last 50 years, starting in the late 70s, what you see is a fairly relentless 50-year decline in wages as a share of the economy's total income. And I hope, again, the pieces of the puzzle are starting to come into view for you. I was interested yesterday, New York Times headline, in fact, I think it was today, New York Times headline, the economy last year grew at its fastest pace since 1984. Huge corporate profits, but Americans are discontent, are gloomy. That was the New York Times headline. And the whole story was devoted to why is it that even though corporations are doing so well, the economy is growing so fast, Americans are angry and gloomy and frustrated with the economy. And the conclusion of the New York Times was that it's all about inflation. Well, that's partly true, obviously, because, and we're going to get to inflation later on in the course, but as dollars are worth less and less, even though your wages might be going up, if the cost of everything else you're buying with those wages costs even more because of inflation, well, then you're not going to be very content. That's true. But what the New York Times failed to talk about is that what we're talking about today, that even though the economy continues to grow, and even though profits continue to increase for big companies, the share going to the typical American, the typical, certainly hourly worker, continues to drop. Could it be, perhaps, that the discontent comes from that, not just from inflation? It's interesting if you compare the United States versus Europe in terms of the share of the economy going to worker pay, you find there is a fairly substantial growing difference. In Europe, you have over time, again, starting in the year 2000, the latest data we have goes to 2015, but you can see that in Europe, the share of the economy going to worker pay has kept up pretty well. In the United States, the share of the economy going to worker pay has not kept up. Why is that? Could it be that in Europe it's harder for companies to suppress wages with all the techniques we talked about before? This is also a very important point, and it's based upon the research of three brilliant researchers, and it was an NBER working paper, came out in April of 2019. Where is it that the shareholder wealth has come from? I mean, is it from innovation? Is it from productivity? Or is it from someplace else? And they looked at two periods, 1952 to 1988 and 1989 to 2017. And here's what they discovered. In the first period, 1952 to 1988, shareholder wealth came mostly from economic growth. Shareholders did better and better as the economy as a whole did better and better. That is, companies were becoming more productive. Companies were innovating. And that productivity increase, those innovations, that growth was responsible for 92% of the increase in the share values of those companies. Well, let's compare it to the second period, 1989 to 2017. And what we see here is that economic growth accounted for less than a quarter of shareholder wealth increases. But this area here, more than half, 54%, according to these researchers, came from what would otherwise have gone to workers, basically a transfer from wages, worker wage suppression, efforts by companies to keep wages low for the purpose of higher profits that translate into higher share prices. Now, why did this happen, and why, I guess the best way of saying it is that why did you see this shift over these two periods? What was the driving force? It gets us back to the question of the purpose of the corporation. What is the purpose of the corporation? Why do we have corporations? What are they supposed to be doing? Is it only about maximizing shareholder returns? Well, what is the responsibility of the corporation in your view? And this is a complicated question, and I'm going to go over it with you, but it's important. A, in your view, corporations have responsibilities to their employees and their communities, even if this means sacrificing profits and shareholder returns. Or B, the only responsibility of corporations is to maximize profits and thereby shareholder returns. Or C, over the long term, treating employees and communities well is good for business. So really, there's no real conflict. What do you think? Go. Well, almost half of you think it's A, that corporations have responsibilities to employees, their communities, as well as their shareholders. And that means it might mean sacrificing some profits and shareholder returns. And a few of you, 13%, think that it's the only responsibility is to maximize profits. And then some of you would like to think that over the long term, being good to employees and communities also means higher profits. Well, this is a bit, again, with apologies, it's slightly a trick question because embedded here is really not only an economic question, it's also an ethical question. What should the responsibility of corporations be? Do corporations have responsibilities to employees and communities, even if it means sacrificing profits and shareholder returns? An ethical question in purely economic terms, political economic terms, in terms of how corporations are structured, what the law and public policy now provides and encourages. The answer is B. In terms of your own personal ethics, your answer might be A. In terms of your own hopes, there's not much empirical evidence. The answer might be C. But of course, it depends on whether we're talking about political economy, laws and rules now, or ethics, or your hopes. What I think is particularly interesting is that we've seen a change over the last 50 years, a very dramatic change in laws and rules and ethics governing our understanding of the purpose of the corporation. In fact, there are two traditions of corporate governance. One very old tradition was stakeholder capitalism. Stakeholder capitalism essentially stood for the proposition, and this reached its zenith in the 1930s and 40s and 50s. It stood for the proposition that a corporation is responsible not just to shareholders, but to all stakeholders, employees and communities and the public in general. And that meant sometimes some sacrifice in shareholder returns. The second tradition of corporate governance was shareholder capitalism, rather new compared to stakeholder capitalism. Stakeholder capitalism, as I said, was the 1930s, 40s, 50s. Shareholder capitalism basically emerges in the late 70s, early 1980s. Aha, you should be saying to yourself. Late 70s, early 80s. What do I know about something that began to happen in the late 70s and early 80s? That was when wages began to level off, even though the economy kept growing. Shareholder capitalism stands for the proposition that the purpose of the corporation is only and should be only to maximize shareholder returns, not other stakeholders. The switch occurred in the late 70s, early 1980s. Why? Well, let's examine that. By the way, the view dominant in the 40s and 70s, Americans, quote, regard business management as a stewardship, and they expect it to operate the economy as a public trust for the benefit of all the people. Now, that was a quote from one of the major CEOs of the day, J.D. Zellerbach, whose name adorns one of the major buildings at Berkeley. He said that in 1956. Now, contrast that with the dominant view since the 1980s. We have bloated bureaucracies in corporate America. I have to look out for the shareholders' interests, and I'm the largest shareholder. Carl Icahn. And Carl Icahn was, in the late 70s and early 1980s, one of the first of the corporate raiders. What do I mean by corporate raiders? Carl Icahn and others like him borrowed lots of money at very high, risky rates, and they used that borrowed money to buy companies that they felt were undervalued according to how much those companies could potentially generate in profits. What Carl Icahn and others did, starting in the late 70s and early 1980s, they targeted companies with unfriendly takeovers. And once they got control of the companies, they fired a lot of workers if they thought that was a way of making a lot of money. They moved to states that were anti-union. They outsourced abroad. They brought in a lot of machinery and equipment to replace workers who could easily be replaced. They got their costs way down, and then they sold off any bit of the company that could be sold off at a profit. And then they sold the companies themselves, because the companies, in terms of share value, were by then worth much more. And then they paid off the loans because they had a lot of money to pay off those loans. That's what corporate raiders began to do. They were the ones who were in the vanguard of the move from stakeholder capitalism to shareholder capitalism. In fact, I think it's not too much of an exaggeration to say that the corporate raiders, who are now more politely known as private equity managers, they changed the rules of the game. They changed the norms and they changed the rules. I remember this very well. In the late 70s or early 1980s, the Securities and Exchange Commission did not allow corporate raiders, unfriendly takeovers, but under a man named John Shad, who was the chairman of the Securities and Exchange Commission under Ronald Reagan, they allowed unfriendly takeovers. I remember Congress debating whether there should be legislation against unfriendly takeovers, and Congress decided no. It was good for the economy. It was efficient. Efficiency dominated, but nobody ever talked about the social costs of huge numbers of people, mostly men, mostly without college educations, who would lose their jobs, and the social costs of having vast tracts of America without an industrial base that had once, particularly in the Midwest and South, given many people jobs and built the backbone of the American middle class. Those social costs were never discussed. The Business Roundtable in August 2019, the Business Roundtable, by the way, is a group of the most dominant, largest CEOs of big companies in America, about 200 of them, very influential. They decided in August 2019 that they would try to come back to stakeholder capitalism. We share a fundamental commitment, they said, to all of our stakeholders. We commit to investing in our employees. This starts with compensating them fairly and providing important benefits. We commit to supporting the communities in which we work. In other words, we're not going to abandon communities and go to cheaper places to make goods. We're not going to leave those communities. And we commit to protecting the environment by embracing sustainable practices across all our businesses. Each of our stakeholders is essential. That's what the captains of American industry said in August of 2019. They wanted to go back to stakeholder capitalism. Did they? How have they responded to the pandemic, Business Roundtable corporations? Well, Amazon's value increased to actually more than $1 trillion. CEO's wealth grew 100 billion, but Amazon has reportedly failed to protect the safety of warehouse workers and fired workers who complained. Marriott paid out 160 million in dividends, raised the pay of its CEO, and furloughed much of its workforce. Amazon and Marriott, major players in the Business Roundtable. Macy's paid out 116 million in dividends, but furloughed most of its workers. I could go on and on. General Motors had the longest strike in General Motors history after the Business Roundtable statement, which the president, CEO of General Motors, Mary Barra, signed. But General Motors refused to increase the pay of its workers. In other words, I think a fair argument can be made that the Business Roundtable really did not change the direction of big American corporations. It did not go back to to stakeholder capitalism. It stuck with shareholder capitalism. And why did it do that? I want to try to defend the Business Roundtable's decision. It did it because laws and rules did not change. Every incentive was still on corporations to maximize shareholder returns, not the least of which was the incentive that we talked about before, that more and more CEO and executive pay was in the form of shares of stock. So obviously, notwithstanding all of the nice verbiage, these companies are going to continue to try to maximize shareholder returns. And maybe that's what they should be doing. It's only really later in the semester where we'll get to a deeper understanding of not only the ethics, but also the laws and regulations governing corporations, CEOs, executives, the very wealthy, versus laws, rules, and regulations governing how the bottom half or the bottom 70% of Americans and American workers respond to what is happening, their declining share of the total pie, and what they can possibly do about it. My defense of the Business Roundtable is basically they are prisoners of the same system they inherited. On that upbeat note, I'll see you all, or at least I'll talk to you if I don't see you next week. Take care. Bye.